Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for December 2nd, 2024. We are recording this at 1 p.m. Eastern Time, and this is episode number 457. So today, the option professor is back for a market outlook episode from him, and he's going to talk about the three best option plays for the end of the year. So I'm going to go ahead and turn it over to him.
Okay, thank you, David, and welcome everybody here to a bright Monday morning after the long holiday. So hopefully everyone has got their boat legs back. Just as a way of introduction, my name is Jim, the option professor. I have been doing options for decades and decades, so I'm very familiar with the product. And I've been to the Options Institute for Advanced Option Training, and I've done seminars on options throughout the country for decades. So I'm very familiar with options. I'm going to share my knowledge with you. Today, I'll be sharing with you my opinions and my observations, but I won't be giving out any advice. But I will be showing you things that, in my opinion, look pretty good. And so I will go into those as we get going. If you have any questions, you can always put it in the chat box there, and I'll be more than happy to try to get those questions answered. So if you have a stock you'd like to look at, or my opinion on what a stock looks like that you're holding, I'd be more than happy to show you what my stuff is saying. Okay, so let's get started because I'm going to go over all the markets because I follow them all. So let's start out with the S&P 500, and you can see right there. Let's look at the 20-year graph so you get an idea how high we are. Now, if you ask me, is this extended? I say yes. If you ask me, is it strong? Yes. And if you ask me, does it look like it wants to accelerate to the upside? It's certainly creeping that way. But it's also telling me as we go into 2025 that this thing is either going to go parabolic up to some 65, 6,600 number, or something's going to occur once Trump gets in there on January 20th that's going to upset the apple cart. And if that's in fact true, then obviously a reversion to the mean is going to be possible. So I don't know if it's 2025, 2026. I don't know if it's Q1 once he takes over. I don't know when it's going to happen. There's no evidence of it happening now, but I know because of there's 20 years when it gets way away from these lines, and now it's ridiculously far away. It does revert back to the mean, which means we'd have a correction down to either the red line, which comes in at 59. Excuse me. We come down to the red line there, which would be 54.74. Okay, 54.74. Next one down is, let me get it back on the cursor here for December. 4,900 and then 46 and change. So those are your three levels where a reversion could come back to. And with the minimum being 5,300 and we're almost at 6,100, that's a pretty good turnaround. So that's what I'd be on guard for in quarter number one. If all these wonderful disruptive, drain the swamp, make them pay their way, mass deportation, tariffs on everybody. If all those wonderful ideas don't work out as wonderfully, then if we started to get a sell signal, realize that there could be significant downside potential. Not many people are looking for it. I'm not looking for it. I just know it's going to happen at some point. So that tells, and the further away we get from the lines doesn't make it less likely. It just makes it the drop back down to the red line going to be more dramatic. So I'm definitely monitoring this, and certainly there's no evidence of a turn right now. So from that standpoint, like I say, I'm just trying to tell people, know where your exits are when you're on the highway, because in case you have to get off the highway, you don't want to be looking at the map when it starts happening. And again, strategies up here could be the collar strategy, where you sell an out of the money call and buy a put underneath, and now you've got your equity bracketed. I can get into that on a couple of stocks that you might want to look at doing that on. Second thing is you could do a married put where you just buy insurance on your stock. And then, of course, like any insurance, if it doesn't kick in, you lose the premium. But at least it does something to protect your equity because, again, the equity, I'm sure your accounts must be near an all-time high since that's where the prices are. Okay, let's turn towards the next time frame, which is 5-year. Again, there the blue line would be your target if it had a medium pullback, and that's 55.38. So you're still looking at a pretty good hunk of change if it has a significant pullback. Even a minor pullback on the 5-year to the red line takes you to 58 58.60. Yeah. So there's plenty of room to go down if it starts rolling over. Right now, there's no evidence of it at all, though. Okay, so here you go. You got, let's do the bouncing balls. RSI is 73. Up, RSI over here was more like 70, 73, call it. Over here at the next big high up here, it's 65. Up here, 66. And now we got a brand new high and it's at 66. So this RSI here has never really been exceeded. And again, so it's really going to be a blow off to the upside. And then your first sign of trouble would be getting under red, and getting under red would be 59.62. So again, you're almost 100 points above the red line. So again, this is looking like parabolic to the upside where you go up to 6,200, 6,300 fast, or it's going to be a deal where we're going to start getting some cracks in the armor. Where's the crack in the armor coming from? If it happens at all? Well, looks the monthly graph. Up here, you're in the what, 70s, high 70s. Over here, you're at the 60s. Here, you're at the 70s, not the high 70s, and here we're at 70. So there's a bit of a divergence up here, but you got to get these red line pointing down if you're going to get any action on the downside. And if you're going to get a significant action like we got back here, you're going to need to get blue and green rolled over. And with them up here already, the likelihood of them turning over is pretty low. So this is no time to be terribly bearish unless you start seeing some cracks in the armor. And again, there's no cracks right now. There is a bit of a divergence, so it does look like it might be running out of steam. But again, this thing could also pop 200 points on the upside on a stampede going into the end of the year. I was listening to Bloomberg. They said the last 2 weeks of December and the first 2 weeks, our first week or so of January, are historically, going back to a long time ago, the best weeks for stocks. Now that they've said that, probably be the worst week for stocks. But anyway, that is the story with history. Let's look at the 5-day. If there's anything here that might give you anything. There is a big gap down here. You know, there is a gap. Where's the gap? Way down here at 5,700 and change. This thing's gone on a big run. But let's see if there's anything here that tells us anything. This is the 5-day. Again, everything is not in anything but a positive formation right now. What could you say negative if you were nitpicking? Well, up here, your RSI hit 70, 77. Okay, hit 77. And then it hit here, 71. And then up here, it's at 70. So again, a bit of a divergence, but until you get something pointing down. Now, today's Monday. Could tomorrow be turnaround Tuesday? It's possible. That's Tuesdays and Thursdays are sometimes turnaround days. So would the 1 day give you the first inclination? Of course. Now, the 1 day, again, is starting to get a little bit under red. That number comes in at 60.48. That's kind of where we're trading right now, according to my screen. So getting underneath 60.48 would be your first sign that it could be turning. The next sign on the monthly is getting underneath 60.20. 60.20. So there's a couple of numbers to hang your hat on. 60.48, where we are now, and 60.20. And then if you were to break those two and get these things to point down, the red line over here again comes in at 59.62. So there are some key numbers if you're asking me. And a full Monty pullback takes you all the way down to 58.88. So we'll have to see what happens. But right now, obviously, all systems are go because it's above all those averages and none of them have crossed over. So there's really no way you can say this thing looks like it's going to do anything but steady higher. Now, there was some people who said that when the market comes in up 20% or more, the time frame between December 21 and the end of the year is sometimes muted, the maximum being about 2.5%. So what I did today was I took the November 21st time price, the high, which was 59.63. From the high, Well, let's just say, well, if we did it from the close, where did it close that day? Let's see. Yeah, it closed at 59.69. So if you go 59.69, you add 2.5% to it, we could have an upside to 61.22 and still be in a relatively muted end of the year rally. So there is some more room on the upside if it wants to go. 61.22 would be a number to maybe keep an eye on as well. Okay, let's talk about the Qs. Okay, now on the Qs, again, looks like it wants to take off. It's trying to take out that high. So this is totally an acceleration phase. You'd have to get back underneath 500, 500 or 505 to turn this thing down a little bit. No evidence of that today, that's for sure. On the 1 month, again, your RSI up here in the 70s, high 70s. Now we're right back at the high, and where's the RSI in the 60s? So there's a little bit of a divergence here. But again, these moving averages don't lie. They're extended, yes, but they're still definitely pointing up. And I see no evidence of a turn on the trend. Don't forget, when I do a divergence, that's not the only thing I'm looking at. I want the trend to be going down too, and that's not happening. So here again, you'd have to get underneath some of this stuff, and it's just not there yet. So again, the market looks like it might try to have a year-end rally, and we will have to see if that'll happen. The IWM was up over 10% last month, the best performing one. I told people about the change between small cap and big caps back in July. So this thing has been on my radar since July as far as making a turn. Let me show you what I'm talking about there. Let's go back to July and see how it worked. Okay, there's July. You see how it started to turn and turn? A couple of false breakdowns, but this thing has been pretty much on the rise. Look at the blue line, pretty much rising the whole time. So definitely after the summer, it was a total get into the small caps, and the small caps have done you well. Now, is there divergence up here? Well, you got RSI at 75, and here you got it at 68. You got a divergence up here, and you got a little bit overbought. So this thing is having a harder time now because it's running out of some steam. That doesn't mean it can't get steam. And that doesn't mean it's going to drop too far because the line right here comes in at 235. So it could drop 6 points and still be in a very good market. It filled the gap. So that's done. That's the time you should load the wagon right down here on the blue line when it filled the gap. You know, buying just any willy-nilly time is very dangerous. So that's why you try to buy when they're on sale, sell when they're not, that kind of thing. On the 1 month graph, again, you had big high points on RSI over here, way up in the 80s. And then over here, you're much less. So that's why I'm saying that this thing has run out of steam a little bit. It maintaining under 241, if it does that, would start to turn 240, 241. And then, of course, you got some support down here. And then you could have a bigger drop. But right now, it looks good. Just stay above 240 and 241. But again, that divergence here tells you that something could be weakening. You got to keep an eye on it. One thing that could maybe cause it to weaken, and probably weakened it today, was the 10-year note rising again. Rising yields is something that the small caps are not too keen on because a lot of these guys, small caps, they got to borrow money to keep going. 40% of the index is not profitable, so it's a dicey one to begin with. Now we're up just a little bit, but earlier today it did pop even further. And again, down here, where are you? You got 28 there, and you got 38 there. So you got a divergence. It's trying to make a turn. Fed meets the 17th and the 18th of December. You have to see if, in fact, they're going to. You have to see if, in fact, they're going to cut a quarter of a point. That's what everybody thinks they're going to do. Probably what they are going to do. But then those cuts might become a little fewer and farther between if the economy keeps going, if the inflation numbers are sticky, and if the jobs market remains strong. Now, the jobs market, again, the openings are definitely dropping off. That 2 to 1 is done. 2 jobs for everyone looking, that's long gone. Actually, hiring itself is supposedly at a 2014 low. So they're not even hiring that much, but they are keeping their staff and the wages are growing, albeit at a less rate. But again, you know how it works. You stop your temporary hiring, then you stop posting ads on the jolts, then you stop hiring in general, and then you start cutting. That could be what happens if things get dicey next year. And if things get dicey next year, maybe they can drop the rates. But right now, the way I've been thinking is that yields are in a long-term uptrend and that has not broken. And that blue line is not going to change overnight. You see, it changed back in 2020 and it had been going kind of down ever for a long time, right? For years, it was going straight down. So when this thing turns up, that's like an ocean liner turning. It doesn't turn all the time. So bottom line is we know our main point right there is 360, 350. That's the point. If it ever breaks that number, then this lower interest rate next year story makes a lot more sense. If it starts breaking above 450 and 5, then obviously something's changed and everybody who's talking about lower rates next year are going to be wrong. So, and again, if the rates do go up, that could be one of the reasons the why the stock market may have a big correction in January or February. Again, you've got the budget deficit over 2 trillion. It's a historically huge number. And you've got 2 guys down there who I don't even know why they're in the government, but Musk and the Indian gentleman, I can't pronounce his name properly. So these guys are down there in this new unit slashing costs, supposedly coming up with 2 trillion. I can only imagine if you cut 2 trillion out of the budget, what kind of ripple effect that might have. Certainly it's going to hurt unemployment because they want to fire everybody down there. So obviously that would obviously make a negative effect on the employment picture. At any rate, and then of course, like I say, defense is going to have to be spent. You can just see how many skirmishes there are. So there's going to be a ton of money spent there. And entitlement programs, Medicare and Medicaid, these things cost a lot of money. So I don't know where they're going to get 2 trillion from. And maybe it's just eliminating everybody's job, which I don't know that helps the economy that much. So we'll have to see. A lot of stuff going to be happening after January 20th. Okay, the other thing is the US dollar. Now, the dollar, obviously, a lot of companies do overseas business and they're multinational. So the dollar getting stronger may not be the best thing for them. I know Trump and the secretary, the new guy, Besson, they like a lower dollar and lower interest rates. Well, 2 things aren't happening right now. We're not getting very much help on the yield, and we're definitely not getting much help on the dollar. This dollar looks like it has broken out to the upside as long as it trades above that number there, which is 103.50, 104. Let's call it 103, 104. As long as we're trading above 103, 104, this thing has a lot of potential on the upside. If they start, you know, tariffing people, if, prohibitively, if they start affecting the GDP, if they start affecting things like, the people's perception, if interest rates were to be dropped dramatically and our yield advantage went out the window, that would be a different story. And then if it starts trading under 103, there you go down to the purple line, which comes in at as low as 89. So we could go down to 90 on a drop and still be in a bullish market for the dollar. And of course, it would possibly go to 90 if, in fact, you were looking at a break of 103, 104. So that's the story on the dollar. It got overbought and it had a pullback. This is called reversion to the mean, something I always talk about. So when you see things way up here, you're not going to find me interested in buying. You're going to find me interested in a reversion to the mean. And it hit the green line almost to the penny. Green line comes in at 105 and change. It held that so far. Blue comes in at 105 even. So between 105, 104, 103, that's your base on the dollar, with a slippage back to the 100 number, or 90 if they really got it going. Okay. Let's take a look at energy prices, because that's something that I think is going to be the story next year. And again, talk about the ideas that could be good for the end of the year. One of the three ideas is going to be in the energy market. And right now I'm looking at, they got a closing price here. Let's go to the CLH 24 and see what the March contract looks like. On the March contract, you are trading at 78.18, down $1. Okay. As you can see on the 1-year graph, this thing has started to trend up. Trend up. Why? Red is above green, green's above blue. That's a trend up. 5-year graph, it's holding on for dear life. But look at those RSIs. I mean, yeah, all holding 40. You know what 40 means to me? It means that it's at the low. If it breaks 40, then it's going to go into the abyss. So that's why this area here is very important. And since I just showed you the 1-year graph has turned up, I think it's a situation where, hold on a second here. Hold on. I goofed up here. I goofed up. You got to put in the right year, buddy. Okay, now we'll talk about Turkey here. But again, the long-term charts on on the crude leads me to believe. Now let's see if the 1-year graph still looks like it's turned. Okay, not quite as much. Okay, so again, the trend has not turned up yet, but I'm looking at higher lows, right? So that's not a bad thing. But you need to get crude back above, as I've been saying, the 60, well, let's call it 70 to 73. If you can get it over that range and get going, this thing is going to turn. So watch it very closely. Again, it has not turned up yet. But on the long-term graphs, the RSI is holding 40, very important. And on the 20-year graph, look at it here. You got the purple line coming in where? At about 62. So if it breaks under 62 and the RSI breaks under 40, we're going into the abyss, no doubt. But since everybody is counting on that and looks like everyone's either asleep or trading it that way, yet again, I'm looking at RSIs holding the 40 number. I think that's huge. And it's a quiet, dead market. So again, these are the ones they say don't sell a dead market, right? That's what we're talking about right here. So this would be one I'd watch for between now and the end of the year. If you start getting a turn, what would be the first turn? I look at the 1-month graph. And again, you're still holding the 40 area here, but you need to get above on the 1 month at least 69. So 68, 69, that's your first sign that there's a turn. Next sign is going to be on the 1 year, which would be above 72, 71. And then from there, the long-term graphs are dying to go up from the standpoint of the RSIs holding 40. So if we can get the 1 month and the 1 year turning, and again, it's always good to talk about these things before and if they're going to happen, because if they start happening and you're not even done your homework, now I'll give you some stocks that are this is one that's very inexpensive, and it's something that I've had on my alert as a strangle going out till March of next year. Why so long? Because the premiums are low. When the premiums are low, you can do both sides for a very fair price. So right now, check it out. You're down here at the lows, and the RSI is hanging around 40. Over here, the RSI was 26. That's a divergence, okay? That tells me that the market selling has run out of steam. So I would watch this one like a hawk. And then basically, you're looking at the, well, on my report, which I'll get to at the end of the broadcast here, I'll show you how you can get these alerts in your mailbox every single Sunday night. This is one that has been in your mailbox lately. It is the energy market, and particularly, I like the idea of Devon on a strangle. That's a call and a put at the same time. So if the thing's going to break and go into the abyss, the put is going to work out better, because look at where you are. This thing is either going to go into the tank here, so your put would get some action, or you're looking at the bottom and it could rally up to here just on a rebound rally, on what they call reversion to the mean rally. So I'll just give you one idea here, because I said I'd give you three. I'll give you one right now. Let's go to the option prices. Let's go to March of next year. All right, there you go, March 21. This encompasses 2 full months after Trump gets in office. I think within 2 months we'll have a good idea if it's, how things are going. Let's put it that way. Okay, on the 40 calls, they cost $1.45. On the 45 calls, they go for 48 cents. On the 42.50s, they go for under $1. On the put side at 35, they go for $1.40. So if you went with a 35 call, a put that hedges in case it goes into the abyss, and you throw in a call at 40, you're talking about less than $3. You want to go 42? Now you're talking less than 250 bucks. And you got both sides positioned all the way till the 21st of March. Limited risk, no limit on the movement, and you've got a good amount of time. That to me could be a very interesting thing, because I don't know that energy is going to go for the rest of this year and the first quarter of next year and not move. I just it seems to me unlikely. So that, therefore, I thought that was a pretty good situation. Energy, that's one that I would keep an eye on. And they say hedge fund managers are buying into the energy market now. So that's not a bad sign. Okay, now we're going to go back and go over the gold market. And here's December gold. Okay, gold doesn't like this Treasury Secretary. Do you know why? Because the Treasury Secretary was on Bloomberg, and he said, quote unquote, to think that Trump is going to be inflationary is absurd. Absurd to me is a very strong word. Apparently, that is why gold is having some more troubles here. Now, gold is pretty simple for me because I follow the trend. Now, I don't want any part of it at 2,800 because obviously I don't buy things when it's way up in la la land. Down here was a lovely time to get involved. Okay, now in the 5-year graph, but it's in an uptrend. But, the uptrend is having a reversion a bit. You can see right here, it came down recently to 25.89, and the moving averages were 25.29. So it came down to that region, came back up, tried to get above the red line, which is 26.68. And so far, it has not been able to do it. On the 1-year graph, it's really been an excellent thing, because you can see it just has not violated the purple at all. But look what happened. It came right down to purple. And what a time to take your shot at 25.50, which is what I was suggesting in my weekly report, that this was the number. If you were interested in gold, start sniffing around it right here, because it's right on the support. And boy, did it have a nice bounce. In fact, that was the best bounce in 2 years for a weekly move in gold. So this is helpful to have this kind of information in your box every Sunday night. Now, right now, it's trying to hold on to the red here, and the red comes in, I think, at 26.20 area, 26.25. So you can see that has been holding up. So that's a key number, 26.25. And then, of course, where the purple is right now is 25.63. So if you were to take out 26.20 and then you take out 26.50, it's going to open the door for a very big drop in gold, something that's going to shock people. Conversely, look at that blue line that does not want to go down. Green had broke, red has broke, but blue is just meandering. And that's just what IBM did recently. And I got a very nice rally out of IBM because I noticed that. So right now, the blue line comes in at 26.86. If we can get back above 26.86, I would say that it's going to go to a new high. So there's some numbers for you to chew on. 26.20 support, 25.50 support, 26.86 resistance, and above 26.86 obviously, maybe make a shot at that highs. That's how I would see gold. And some of the gold stocks are pretty cheap. Newmont Mining. Again, this is why we like the strangle. You do a 45 call and a 40 put, or you do a 50 call and a 40 put, and this thing goes down to 30, you're going to make money on one, the put. So if the total you put in there is $3 and it goes from 40 down to 30, then the 40 put is worth $10. If you put in $3 total, that's still a good jump on your money. And when you do a long strangle, the most you can lose is the premium. So obviously you're trying to find lower price premium. So if you lose and it doesn't move, obviously it doesn't move, that's the risk on a strangle. The both premiums will come down. Or one of them explodes and then you get a good move. Up here, again, say you're buying your calls up here. Well, would it have killed you to throw a little put in there for insurance? If you did, rather than losing all this money, you would have made a big hit. So that's why I gravitate towards the strangles, because in this crazy world, anything can happen. Another metal that I keep an eye on is copper. Supposedly they need this in data centers and everything else. So you'd imagine with the infrastructure being the big thing. Every time I hear infrastructure, I think of the word copper. But this copper, maybe they can't spend. Maybe the budget, the Musk and his buddy down there with a machete, he's going to cut some of that out. I don't know. But I just saw a big special on data centers, and they're growing like weeds. And I think they need some copper to make those things happen. So we'll see. We'll see there. But on a 20-year graph, it looks like that 40 number is pretty big. This is another one that I have said an idea to look into is a strangle, because if it breaks 40, Lord knows where it's going down to. And if it starts getting good news, that trend's still up. So if you see it break above that red line, which comes in about $45, it could get right back on the bicycle. In fact, that's the way it looks like it wants to go, as long as it holds this 40 number. But all I can tell you is these options are pretty cheap. So you go out till March, and that means what? You got a lot of time on the clock. You play it both sides, and you look for all heck to break loose. Dead in the water, yes, you're going to lose money. But if you get a volatile move of 10 or 15 or 20% on the underlying stock, you'll get action on these, because the implied volatility on these options like gold, energy, and metals is not very high right now, which means when you're the buyer, that can be to your advantage because the option premiums are very fair. It also leads you to be able to buy more time because they're cheap. That's what you kind of do when options are cheap. You buy more time, because buying more time is not that expensive because the premiums are down. All right. I'll tell you another thing I looked at for the data centers. They need energy, and I saw they were talking on Bloomberg about there's been 117% jump in the usage or whatever for the natural gas area. So I'm looking at this thing very closely, because on the 20-year graph, if it can go and break out, there's a lot of area up here that it could go. And with the blue line rising like that, red and green above it, I'm kind of thinking that might happen. And the option premiums, because this thing has not made the move yet, are low. So a 1-year option on this, or a 6-month option on this, or just a longer term play might not be bad, because if it can break out of this, I mean, it has shown the ability to get above the purple line. It's having trouble with gold. Gold comes in at around the recent highs, I guess, 36. So if we can get this thing above 36 on news of any type, that's how you make money in options, is buy when the implied volatility is low, and then news hits it and makes the volatility come in. So again, risk is limited when you buy a call. Find your strike price, find your expiration date you like. But this is something that is involved in natural gas. And I had another one here that was involved in natural gas, and it certainly was a friend to me. And that was Williams Companies. And although it might be coming off now, that certainly had a run, didn't it? So that's why I'm trying to keep an eye on range in case it's going to play a game of catch up. The other thing that is kind of inexpensive right now is China. This large cap includes Alibaba. Now, like I say, I loved it down here. It was in the reports at $26. Ran all the way to 38. The calls cost like $115 at the time. Even a one going out till next year March only cost 200. And so obviously that was a steal. And of course, that was when Tepper and Burry was announcing they had bought into it. But again, they spike up on an order imbalance. The order imbalance is satisfied, and the market can't go any further. Now, like I say, there's your line in the sand right there at 38 bucks. So you know exactly where the line in the sand is, 38 bucks. If it gets above that, you're going to get quite a bit of action. So again, it pulled back. I don't know if it's Fibonacci pullback or not. We can check on that because I think this is an important one to keep an eye on. They just announced their manufacturing is back into expansion last night. It's above 50. So it's expanding again. And these guys have one of these political meetings this month, and they're supposed to announce a bunch more stimulus. So your low there was about 21 bucks and 38 bucks. So 38 minus 21. Let's put the 61% on there, and it should have pulled back about 10 bucks. Well, it just pulled back, down to a low of 30. It's pulled back about 8 bucks. So there should, and look where the moving averages are. I said 10 bucks would be 27, right? Look what all the averages are. 27, 27, 28. That should be the low area of the pullback. That would be a Fibonacci pullback. So that neighborhood between here and 30 should be an area that could be a good place to take a peek. And these options don't cost very much. That also makes them attractive to me as well. So that's a story between now and the end of the year as well that you could keep an eye on, and it could be interesting to see. So that gives you a little bit of an idea of some of the things that are happening in the areas that we just mentioned. And let's talk about Bitcoin, because I've been pretty good on Bitcoin because I'm following the trends. That's why. And the trends are telling you certain things, and that's that. So on Bitcoin, you go out to the 5-year graph, and what do you got? Right in here. That's where I was talking to people. This is where we're talking about MicroStrategy at 145 bucks and 180 bucks. This is where we're talking about Coinbase at 150 bucks. We were talking about Hut and Riot and Mara. In fact, I've got a report for people who sign up for my my weekly service, where you get a Bitcoin report that I've listed, I think 13 or 14 stocks involved with Bitcoin that could be interesting looking forward. I don't know that much about this, to be honest, but I've read. And so I think there's something to this halving and post-halving pricing. That's kind of what I'm hanging my whole hat on here, that and the trend. So the bottom line here is that the time to really load up was when I was talking about it between 60 and 65. That was where you had a chance to get into all that stuff at a great time and also make some very good money here on this blast up. There is a gap there, and there's a red line there. So what do I think could happen? I think it could correct down to 75 grand to 80 grand. And that would also come in where these tops are. What do we say about former highs? They become support. So do you understand where I'm coming from? Rather than chasing tigers up here and getting bit, maybe be patient and see if you get a correction. If the stock market's going to correct in January or February, I would imagine that would be the place that it would happen. Now let's talk about that halving thing where I have some belief, although I'm obviously like everybody else hoping against hope, but on the halving, after they do halving, which happens about every 4 years, 2012, 2016, 2020, 2024. Now what I've been told, I haven't done any independent verification, but they say that the Bitcoin can go up 300% average in the 12 to 18 months after halving. And they say they have historical evidence. So if that's true, and this Tom Lee's been talking like that. And so bottom line is that if it's going to do that, and obviously it looks like it might be doing it because it just went, we started out at 50 grand after halving and we already went to 100. So it's already doubled. So to think it might go to triple is not exactly a craziest idea in the world. So, but it's got till June to do it. And that road between now and June could get rocky. And that's what I'm talking about. So if you think the ultimate destination is 150, first of all, I definitely would be interested in options rather than just buying it, because if the thing drops down to what, 70, you're going to lose $26,000 a coin. At least with if you go limited risk option out till next summer, yeah, your options will be down in price, but you got staying power and you got no more risk than the premiums. To me, that's more interesting. So if you do get a pullback again, those 14 stocks that I've listed are certainly a place to start. And those I also listed 7 ETFs. So those are the vehicles people use to play Bitcoin. And some of them now are optional, even the ETFs. So they got all the, it's like DraftKings. They got all 9 million ways to bet now, right? So that's what I'd be looking for to see if you can maybe go fill that gap. Any evidence of it? Let's take a look. Okay, you got double high up here. And where are you? R size 82. And then the R size only what? 65. I got my divergence. All right. So if it breaks under this number here, I think it's 90, 92. Starts breaking under 92. Yeah. Why not go back to 75, 80? Where are these numbers come in at? Yeah. Look at 80 right there. And there's a gap. So why can't it come back down towards 80, 70, 77, 80? It already got a divergence. All you need to get is one of these lines pointing down. You don't have anything pointing down yet, so it's premature. You got the monthly pointing down. Let's see. On the verge. So, it's hanging on for dear life here. If it starts getting above 98 grand, you're going to break that 100. You're going to break that 100. It goes back above 98, 99. And like I say, you can see there's a bit of an abyss here. This is on a 1 month graph. It could go down to gold. Gold comes in at around 89. So there's your numbers on Bitcoin. And it is holding on for dear life. It has not broken down. Yes, it's rolled over a little bit, but blue's not rolled over and purple either, and green. So they're all meeting right there. And this is where something big happens. Let me tell you generally, my opinion. You got a traffic jam right at 97.5. 97.5. So if this thing goes 98, 99, that traffic jam is breaking to the upside. With the blue line pointing up and the purple line breaking up, you'd have to bet that way. But if you start breaking underneath this 96.50 area, 96.500, then of course it opens the door to start the drop. And on the 1 year graph, what's the number? 95. So again, you break under 95.5, 95, it's going to start the possibility. Again, here's the key numbers: 95, 92, 95, 92, and 97.5. So on the upside, you got resistance 97.5. On the downside, you got support around 95, 90, 95, 200, and 92. So I think it'd be smart to kind of, go with the flow. And again, I've got 13, 14 stocks and about 7 ETFs that could help you navigate what vehicles you might want to keep track on. And then obviously limited risk options. So at least you know what you're going to lose if it all blows up. Sounds to me like a better idea and for many people, because, identifiable risk when you buy the options, and identifiable expiration date. So strike price and expiration date. And again, since it looks like the 12 to 18 month period takes you to the end of June, common sense would tell you if you're going to buy any options, you'd probably want to take your expiration past the end of June, so that at least you're in the game for that period that historically has given you a very nice pop to the upside, which is the post-halving environment. And obviously, I think this has something to do with that, because you can just see that's an inordinate move. So keep an eye on it and see what happens. On the international markets, I've been showing people what's going on. So on emerging markets, people still want to get into those because they think, well, they're cheap. They're cheap compared to the US on a PE basis. The whole world is, because the whole world doesn't have our growth. We've got the tech. But this thing rolled over as soon as Trump got in. You see, Trump got in and bam. So it's holding on for dear life. Another one would be Europe. Again, Trump got in and traders got out. Again, they've hit lows. They've hit lows. So you got to see if that's going to be an established low or not. Let's take a look at, we already showed you China. How about Japan? Japan's supposed to be hiking interest rates. That could be a big story for the yen. The yen could firm up. But if the yen firms up, that would be bad for them because they export. So we'll have to see. But this is, somebody likes the fact that the yen's going to firm up because look at this. That thing just made a turn. That's what I'm trying to say. If they believe Trump is more bark than bite, then these things are at very good discounted prices. Plus, we had a divergence here. You see, I'm at 35 down here, and I'm over at 39.45 over here. So there you got your signal. Once you got above the red line, that's your trigger point, and bingo, you're on the road now. So Japan stocks look pretty good. Let's take a look at our Mexican neighbors, because I think people are aggravated with them because China is making cars down there and circumventing the tariffs by going through Mexico. That's not going to work. Since I know about it, I'm sure Trump does. So here you go. You got a low here at 54 on the RSI, 45. Down here, you're at 32. So there's no divergence. Trends are very much down. No help here. No help here. And the other Latin American country, which I think is about as dicey as you get, is Brazil, because I think their leadership is all over the place. And let's see what Brazil looks like. I'm sure it doesn't look very good. Oh, it's gapping down, yeah. They almost look like they're going communist or socialist or something. So that's why that's in a rough place. There's two countries that are looking good. Which ones are they? I'll show you. Australia. And they've got good numbers coming out, and you can see they're in pretty good shape as long as it stays above here. It could get a pop as long as it stays above there. And then our buddies up in Canada. That's why the guy Trudeau was at the Thanksgiving party down Mar-a-Lago. He goes, listen, our stocks are going up down there. Don't kill us, man. Come on up here and have a Canadian beer, whatever. So you can see that one had also been pretty positive after the election. So those two are countries that have not folded like a lawn chair. The other countries will be dependent upon how much bite is in the bark when Trump starts turning substance or rhetoric into substance. And that will be happening again after January 20. So that gives you a little bit of an idea on some of the international pictures that are going on. And I certainly gave you a overview on the world right now. As far as sectors are concerned, you know, we've had a very big run up in the softwares, but that stalled out last week. Let's see if it's still stalled out, because there was a transference from the tech shares, the software. You see a little bit of a 81 there, and then you had a 75, so you had your reversion. So the question is this temporary or not? Because SMH has been outperforming in the last week. SMH, of course, is your semiconductors, which have had a hard time. I'll show you exactly how hard they've been. And it questions whether this AI spending is going to continue. But right now it's having a great day, but it's running right into resistance. So we'll have to see. See, this is a classic example of why the charts can be helpful. Everybody thinks this is having a great day, and it is. But it's also running right into 248.85, which is the blue line. So it ran into that number. Look what the high was today, peaked through 49.15, and now it's trading underneath. So we'll have to see. But it does look like it wants to break out to the upside. And then on the 5-year, again, traffic jam and pointing up. So this thing could start screaming big time. I'd keep an eye on this. And this, you go to the top 10 holdings and you can figure out what stocks are going to make it move. But it does look like this thing here is at a traffic jam all around what price? All around 245. all around 245 and 247. So we're right here. We're right here. You wouldn't want this thing back under 245 and 241. And if you start seeing 250, I would say it's maybe even going to go after the high. So keep an eye on this. This could be the exciting place to be if they can get through 250, if they or 249, 250. And of course, if that happens, that could be something that really takes off because again, the RSI is down here. It's got plenty of room to move. So watch the semis because they are on the verge of doing something here. One last one before I explain what I can do for you. Google. This is another one where I'm expecting big things out of. Okay. Because look at that traffic jam right there at 170. Now everything's pointing up, so you would imagine it's going to break to the upside. And the options, well, they're up now, but last week the thing closed at 170. The 175 calls for the end of the month were going for like $1 or something. You know, you go up to 180, $1 can turn into 5. It goes up to 185, $1 can turn into 10. And a month's a long time for this thing if it starts moving. So again, I thought this was the bargain. This would be the one of the best plays for the end of the year that I talked about. Yeah, well, this could be one of them. Now, like I say, you can slap on a put at 160 just to protect yourself in case it's going to fall out of bed. But the chart does not look like it wants to do that. And on the 1-year graph, again, big traffic jam right here. And you've got the blue line holding it up at 171. Excuse me, 171 and 172. And you've got red pointing down. That's not good. But you start trading 175, 180, believe me, red will turn back up. So again, this is a very critical point where a strangle would make a lot of sense as a speculative situation, because again, I don't think it's going to stay the same for the rest of the year. It could, but frankly, like I say, I think the premiums, well, last Friday, they were great. Now they're good. But the point is if they're really going to break out towards 180, 185, or even higher, or, you know, and maybe you could even look into January if you think there's a big move and give yourself more time. Again, they tell me the last 2 weeks of this month and the first week of January are some of the best weeks historically for the stock market. Well, if the stock market's going to go on a big run and this stuff starts breaking above 175, there could be a whole bunch of people who think this thing is cheap. So again, there could be a good value in the Google thing. We'll have to see. And again, the put underneath does not cost you much. So the red line is pointing down. So the red line is pointing down, and it's going to be, getting these other ones to point down. If we break under 166, 165, this thing has potential if it really wants to drop, down here. So like I say, I think this time right now would be a nice place to price out some strangles. Okay, we're getting to the top of the hour. I'm going to give you a little bit of a what I can do for you deal here now. And David's going to put up a link where you can click on the link and get started. Now, again, I'm Jim, the option professor. Again, I take all my knowledge, all my experience, and I come out every week with an options alert. And the option alert has 3 things going for it. It's got A, strangles, like I'm just talking about on Alphabet. B, it's got levels on the stock market, like I just showed you, that I think are very important. So that could help with your trading. And then 3, it's got long-term plays where I think the market may go on a big run, and it's worth taking a shot now, going out 6 months or 12 months, and basically having a position with limited risk. In other words, like I said, when FXI was at 26, we went out 6 months, and obviously we got a nice move before the 6 months. We put things like a micro strategy down there at 145 and 180. We put Coinbase down there in the 150, 200 area. We put Palantir down at the $31 area. So there's been some very good nuggets in the level 3 area as well. And it doesn't kill you to have some long-term plays with the short-term plays going at the same time. Again, volatility, I didn't show you this. I'll show you real quick because I only got 5 minutes. But I tell you right now, the VIX is hit a low of 13.5. It is now trading at, come on, VIXy. It's at 13.5. You can see that is a very, very low level. So again, going back 20 years, this is a very low level. So if it gets above 15, gets above 18, gets above 20, when it does that, if it does that, that's when you want to make sure you have something on the sell side, because the whole world is complacent right now. The whole world is obviously very bullish, and that's great because that's where you should be. But if the tide changes and this changes, you want to be all over it. And every week I'm on top of it. So it's not going to get by me because I'm watching it like a hawk. So at any rate, every Sunday night in your inbox, you'll get the options alerts with those 3 items. You'll also get a masterclass. Many of you need more education. Rather than going and buying a separate course, we have a course that goes for $400 and we give it to you for free when you join up. And you get to talk to me with your questions as long as you do the quarterly deal. And the quarterly deal normally goes for $397. With the holidays, we're cutting $100 off the price, so it's only $297. And what do you get for $297? You get the options master class, which is what? A $397 value for free. You get the options alerts with the strangles and the long-term options and the key technical levels. You also get coaching, and coaching is for 1 hour, but a lot of people split it up. That's a $200. I'm only giving away coaching for new people because I want you to understand more about options. I want you to talk to somebody who knows about options to help you with your questions and who's available to you. So that is a very good value too. And again, it's $200 for free because I'm including it in the $297. So when you go and click that button and you go down to where it says to get started, hit this link. You put your information in there. You go down to where it says monthly, a quarterly and monthly. Hit the quarterly if that's the way you want to go, which I suggested because it gives you 90 days of alerts. It gives you the masterclass. It gives you the coaching. And that means you have a question on anything, on options or a stock. Now, again, people who sign up today can contact me at optionprofessor@gmail and tell me you signed up today. Give me your phone number and I'll call you back and I will personally send you my charts that I have here on the screen, and we'll go through things that you have, and at least I'll show you how I would analyze your stuff, and hopefully it will be helpful in making you make some better decisions. So you get my chart sent over to you, and you get the Bitcoin report with the 14 Bitcoin stocks and the 7 ETFs. And again, I'll spend time with you today to go over how I read these markets and how I figure things out. So that's a lot of value, guys. It's a lot of value. You know what's going on out there, and you know how much it costs and what you get. You're getting to talk to somebody with high experience level. You get it. You're getting a class that you can watch and then call and ask questions about the class. You're getting the alerts every Sunday night. And again, the key thing is you'll be able to talk to me directly if you have any questions. So the link should be on your screen now. And again, let me just see real quick about some questions if I didn't handle them. No, looks like we handled the questions. Again, if you have any questions, just again, you can shoot me an email, optionprofessor@gmail.com. And again, if you sign up now, let me know you signed up, give me your number, and let me get my charts and the Bitcoin report over to you. And let's get started. Because again, we're going into a time frame, I think, that's going to be very active. Come on, the next 90 days, December, January, February, I mean, I think there's a lot of stuff going to be going on. So this would be the time to get that class so you're educated. And also it would be time to talk to me with any of your questions. And then that learning curve that you have, is going to be a lot shorter. And again, whether you're just starting out and you have simple questions, or you've been trading and you have more complex, I mean, come on, I've been doing this for decades. I should be able to help you. So, and I want to help you, because when you're a customer, you're a friend. And if a friend calls up, there's no way you don't help them, right? So again, I'm Jim, the option professor. You've got the way to get signed up right there with the options alerts. I couldn't encourage you more. I mean, we got the VIX low. You've got the president coming in on the 20th with a disruptive agenda. I think volatility will probably pick up. So again, let's do the homework now. let's get acquainted now so we're ready to roll when the things start getting more active. Okay. All right, guys, I'm at the top of the hour, so it's time for me to close it down. This is Jim, the option professor. I hope you guys sign up because I'm hoping to talk to you and help you get to your, help you get to your potential as an option trader through knowledge and experience. So, okay, guys, thanks a lot for being here, and look forward to hearing from you. And of course, until then, good luck and good trading. Have a good day.